Welcome to my market commentary for the second quarter of 2023. In our first quarterly review of 2023, we were celebrating encouraging gains across all sectors within global stock markets. Beleaguered bonds were starting to recover, whilst US equity markets raced upwards. Even the UK FTSE 100, which had already managed to avoid so much of the global market despair, continued to tick on up. Then a US regional bank got into trouble, swiftly followed by the much more impactful Credit Suisse demise, and the air went back out of the tyres. In fairness to both the Swiss and US regulators, solutions were found to this potential banking crisis in record time. It would seem that central banks and regulators are far more adept at resolving these issues after the lessons of 2008. Markets began to recover pleasingly again before the next crisis of the US debt ceiling, which I've already covered in my video and article to all of our clients last week. In more recent days, we've seen troubling inflation data in the UK, and the worrying theme is that wage inflation appears to be running out of control. This has prompted UK investors to suspect that the Bank of England will be forced to raise rates more aggressively, and thus UK gilts, which is supposedly the safest asset class, are now being hammered once again. The global stock market currently reminds me of a happy but crazy Springer Spaniel straining at its lead to be let off in the field. It manages to make some headway before being held back again. The dog's lead in this case is interest rates. Once interest rates stop rising and possibly even start to reduce again, the lead is taken off and our happy spaniel gets to really run and show us what it can do. I'm now speaking with several fund house representatives who are all saying the same thing. Once the market's allowed to run, a truly stellar year is very possible. So the question really is, well, when is the lead likely to come off? As I've said on many occasions, the US is really the biggest part of this puzzle. Dealing with the debt ceiling firstly, the US has gone through debt ceiling impasses on 48 separate occasions since 1960. On any one of these occasions, the US governments of their day could have failed to agree a way forward, and the global economy would have been thrown into utter chaos as the world's baseline currency tanked. In every instance, a deal has been agreed, even if it was at the 11th hour. Why? Well, putting it simply, it would be monumentally stupid for the US not to meet its debt obligations. They would see their currency and standing in the world damaged probably beyond repair, and they'd watch as China took over as the world's leading economy and currency of choice. So the feeling amongst every fund house that I'm speaking with is the same. A deal will get through Congress, but it may be at the last minute. We now see a technical recession in the US as a possibility towards the end of this year. Nothing suggests a huge cliff edge drop in productivity, just no real growth. And this is likely to stimulate the Federal Reserve, the US central bank, into cutting rates, although we can't of course be certain of this scenario. Europe appears to be getting their underlying inflation under control, and so it is possible that they cease hiking interest rates towards the end of this year. The UK looks to be in a bit of a corner at the moment. We expect interest rates to continue to rise, potentially with a small technical recession coming into play around the spring of next year, just in the run-up to the general election. The possible outcome in this scenario is that the embattled Conservative government will dramatically cut taxes, whilst the Bank of England stops raising rates to try and stimulate the economy. So in all three cases, we see the dog potentially being let off its lead between the autumn of this year and the spring of 2024. I've seen some stuff over my 25 years advising all of my very treasured clients. However, I've never seen such a tricky couple of years as we've currently navigated. Ultimately, Shutting down the global economy during COVID has most certainly caused considerable disruption and headwinds. However, we know through looking back over history that markets do recover from war, famine and pestilence. And when the dog is let off the lead, boy, can it run. Our 8 model portfolios have performed as well as we could have expected this quarter. It was particularly reassuring to see our lower risk and ethical portfolios comfortably outperforming the FTSE 100. I do hope that you enjoy your quarterly review. There is an important fund change that I need permission for in the mainstream level 3, 4 and 5 portfolios. If there's anything at all that you need from me, please don't hesitate to call. My very best wishes indeed.